derivative. Now, equity index derivative, it is basically simple, but instead of a stock, an index becomes an underlying. So what we have here, where most widely known or most widely traded equity derivative indexes are Nifty 50 index or Bank Nifty index, which have futures there also and options also. Then there are Sensex futures and options also. Then there's the Nifty Midcap 50, then Nifty Financial 50. So all these indexes have their derivatives. So they derive their value from the index itself. Now, let's understand, how the index future trading cycle is there. So I've been saying that, there are fixed maturities pre-decided for the contracts. So the trading cycle states that, at any given point of time, you will have three index contracts open. This things which I'm explaining right now are based on Nifty and Bank Nifty. So at a particular point, a Nifty future or a Bank Nifty future would have three contracts open. One would be the current month, then it would be the next month and the far month. So currently you will be having option contracts open for May, June and July. Okay, and now expiry date, and how the expiry date is, then it is fixed that last Thursday of every month would be the expiry date for that contract. So that contract gets settled on the last Thursday of the month, every month. So for this May month, the last Thursday, so it is not necessary that it will fall on 30th or 31st only. See, for this contract, the expiry is on 26th of May. However, we still have 2 or 3 trading days at 27th, 30th, and 31st May are still there, but the May contract will expire on 26th. And on 26th, you will have one more contract opening. So till now we had May, right now we have May, June and July. So on 26th of May, when the 26th May contract expires, so on 27th morning, you'll have June, July and August contract getting opened. So that way at any given particular point of time, you will be having three contracts to trade. Now the minimum contract size at the time of introduction is kept at around 5 lakhs. Why it is at the time of introduction? Because as the indexes move up and down, the contract sizes changes. On a periodical basis, it is reviewed and it is revised also. Okay. Now, if you look at the overall option cycle, then option cycle is slightly different than the futures cycle for Nifty 50. Reason being is that we have weekly options also expiry. We have monthly option expiries. Then we have quarterly option expiries also, semi-annual option expiries also, and we have ranges of that. So, for example, you will be having cycles where you will have at least, if you combine all these cycles, so at a particular point of time you will have 4 years of tenures available for options. So say for example you may have 7 weekly expiries open at a one particular point of time. Then you would have 3 consecutive monthly expiries also open, then 3 quarterly expiries, and you will be having 8 semi-annual expiries. So an 8 semi-annual expiries would give you a 4-year tenure overall. So for each and every expiry, the last Thursday for that particular period would be the expiry. So for example, for weekly expiry, say yesterday was a weekly expiry for weekly options contract, and then you had a new contract open. Then the coming Thursday, that which is 26th, would be a monthly expiry. Then after that, the next consecutive Thursday will again be a weekly expiry for Nifty 50 options. So this is how the cycle continues. And say for example, on any given point of time, if that Thursday is a public holiday or an exchange holiday, a day previous to that trading day, that means Wednesday, would be the expiry. So this all terms are prefixed and predefined by the exchanges, so that it becomes much easier for them also to do the settlement cycle, and also for the buyers and sellers when they enter into the contract. Now let's move on. Since we've seen that what is equity derivatives or what is index based derivative. Similarly, when an currency is involved, or a derivative on currency, or a future which derives its value from currency, we would call that as a currency derivative. But then now we need to pay attention here that the underlining is not like in, say, in equity markets. At 9 o'clock we start our markets, 9:50 the normal trading starts, and 3:30 the market ends. So your index and stock underlining and future would be moving in that span only. But currency markets are a 24-hour markets. And it's a global market. It is not that it's an Indian market. So global events will also have impact on currency. And once that will have an impact on currency, that will automatically have an impact on the derivative also, because the derivative takes the value from underlying itself. Say, for example, you have an USD INR pair. So any wild swing in the US markets, or something happening in the US markets, or something happening into the Indian markets, will have its impact on the USD INR pair also. So that is in 24/7, 365 days of impact happening, and that way your currency will also see that impact on the go. So you need to understand that whatever derivative you are trading in, how the underlying gets impacted, and on that basis how the overall impact will be there for my derivative. Just give me a moment. So moving on, then if there are many derivatives on fixed income or interest rates also. Basically in India, it is majorly governed by the government of India and RBI, where we don't have much of derivatives on the corporate side, but there are few. But majorly it will be the interest rate futures which are available with the government of India securities, and the treasury bills which are there by the RBI, or MIBOR. MIBOR is nothing but Mumbai Interbank overnight rates, which is something similar to LIBOR. So that is where our interest rate derivatives will be there. But we need to understand here, the derivatives are moving on interest rates, and interest rates are sensitive to many things. And sharp rise in inflation is also has its impact on interest rates. RBI's policies also have impact on interest rates. The bond programs also have impact on interest rates. Even government borrowing or government spending also has its impact on interest rates. So you need to be very informed when you are trading into an interest rate derivative. And it will be on a notional contract where you buy an interest rate bearing securities, and the interest rate is specified into it. It is again in standardized contracts where the rate of interest will be specified, the tenure would be specified, how the interest rate would be paid. It will be monthly, a quarterly, semi-annually, or annually, and if it is in simple interest or a compound interest, everything will be specified into it. Now, moving on to interest rate options. Now, this becomes even more trickier than interest rate futures, because you will be buying options on the interest rates and not on the security. When you are buying an interest rate futures, you are buying that notional value of that bond. So that means you will be getting interest and it will be moving on the specified interest rate. But when you are buying interest rate options, that means you are buying a 6.5% government of India option, interest rate option contract. So if the rates move up or down, they don't have a linear movement. It is basically a concave or a convex movement. So it's a little bit more of a complex instrument, interest rate options. But you just need to remember that interest rate options are not on securities, but they are actually on the interest rate of interest rather than on the security itself. Then moving on to commodities, I guess many of you would be well averse with commodity derivatives, as After equity, this is most widely traded and talked about in the Indian markets, where commodities such as gold, silver, crude, uh, copper are frequently traded also. Also, you have agri commodities, which include sugar, then it includes wheat, uh, corn. These kind of agri commodities are also there. Even you have soya oil or palm oil, which are right now very much in focus. And also you have base metals such as copper and aluminium, which gets traded into the commodities market. So here it works in a very similar manner to your equity derivatives, where your underlying is a commodity. But again, it has a little bit of an global, or it has an equivalent exposure in the global markets also. Say for example, when crude we have seen, which was trading almost at around 60 or 70 dollars, suddenly after the war has spiked up to 100. So you never had, we no one had in our imaginations also that we would be seeing war, and these times where everyone would be talking about peace. So that is there. Or in a particular point of time, the US crude went into negative, which had a very huge impact on our Indian crude price also. So even gold and silver, these also move through the international markets. Even things like agri commodities, which many of us feel that this, are more related to our Indian markets, it is not that. Say for example, a commodity like sugar, when there was drought in Brazil, the Indian sugar prices or the Indian futures, sugar futures went up. So it is all globally linked because it is mainly on the supply and demand. So you need to be careful again on that how your underlying will react. Now let's understand certain basic terminologies going forward for the options. So in options, as I had told, say for once, if you remember that when interest rate options are there, you will not be trading the securities, but you will be trading the option in interest rate, that is 6.5, 6.6, 6.7, or 6.8 or 7%. So those all are known as strike prices. Say for example, if we conduct that, Nifty currently it is, I'm just taking as an example, if that is at around 16,200, then you have, if you want to buy an option, you will have different strike prices such as 16,200, 300, 400, 15,000, 15,500, 14,000. Range of strike prices will be available to trade. Okay, the reason it is that when you're entering an option, and if you're a buyer of an option, you get a right to either buy or sell at that particular strike price. Okay, so that is the reason we have ranges of strike price. Expiry date, as I've already told you, it will be the date when the contract will get settled. And then European options and American options. So these are the two types of options. There are two different types of option in the cases that this is they have different ways how it is exercised by the option buyer. So if you just want to understand on a simple example, is that say I've taken a life insurance policy. Okay, I've taken a life insurance term plan policy. So my at a point when I will exercise that policy is fixed. It will be at the death of the policy holder. Okay, so that is of a European option where you can exercise only on the expiry date. Okay, while as if I'm taking a Mediclaim policy, so it can be exercised anywhere between from the initiation of the policy to the expiry of the policy. Because in between, anytime if I am hospitalized, I'll exercise my right for that medically. So that's an American option. Okay, you have an call option and a put option, which we'll study in the slides further on, which will have other different implications also. Now, then contract value is nothing but your notional value. Notional value is nothing but it is calculated by multiplying your contract size into the price of the stock. Then you have call option and put options. Now, call options and put options. Say when I have described option, I have always said that it gives you a buyer the right to either buy or sell the security. So when I am an option buyer and I want a right to buy those securities, I'll be an call option buyer. And when I want a right to sell that securities, I'll be a put option buyer. Very simple. If you are a call option buyer, that means you have got a right to buy that security at the strike price or the strike price of the call option you have bought. And if you are a buyer of a put option, that means you get a right to sell your security at that particular price. And similarly, if I am a buyer, there would be a seller also. So the seller agrees to either buy or sell that particular underlining at the desired option price or the strike price. Now to make that deal, say for any insurance policy also you take, there is one thing is that you have to pay a premium. Okay, so how are premiums, to take that right to either buy or sell that particular security at a particular price, how a premium is decided? So there are two components into the premium. One is the intrinsic value, that is the actual value of that contract. Say if you want to understand in simple terms, say for example, Nifty, if it is currently trading at 16,200. If I buy a 16,000 call, that means I get a right to buy that particular stock at 16,000 when currently it is trading at 16,200. That means I get to buy that stock 200 rupees cheaper. So the seller would require at least 200 rupees of compensation from you to give you that right. So that when you enter that contract, you will be neutral. Now, if that contract will be just for 1 day, so then that 1 day time value, he might be subscribing very little. Say that 1 day movement risk, he might take, say it might 10 rupees or 15 rupees extra for 1 day. So that is called the time value. So the option premium will always have two components, the intrinsic value and the time value. The moment you increase the time, say from 1 day, if I take that to 1 month, he will say that during that 1 month a lot of up and down can happen. So to protect not only 200 but more than 210, I would be required to give him that right. So that time value would have many components dependent upon. As in our insurance, the earlier you take, the more premiums you will pay, but the lesser would be the amount since you are healthy. And anything happening in a year, say if I've taken a term plan at an age of 20, in a year, a person who is 20 aged to die, there is a very less probability. But a person at 60 taking a term insurance for 1 year would have a higher probability to die before he turns 61. So that way the premium will differ. Plus, a person at 20 would be assumably more healthy and less chances of attracting any comorbidities, while as a person at 60 would be not that healthy and there are more probabilities of him having some critical illnesses also. So that way the term insurance premium automatically differs. Same concept applies for time value also. The more time you take for the expiry, the more volatile the market is, the more premium the seller will demand. Now, what we had talked right now, where we bought a 16,000 call when markets were trading at 16,200, such kind of an option where there is an intrinsic value, those kind of options are called in the money options, where when entering into that option, it has some inherent value, or you get a right to buy at a lower price in the current market price, or you get a right to sell at a higher market price than the current market price. Now, out of the money options are completely opposite. Say, for example, in our previous example, instead of 16,000, if I chosen to buy 16,400 call, that means currently I am taking a right to buy something at 16,400 where I can buy it from the market at 16,200. That means I would be paying very less to the seller, since he is at an advantage. Only I will be paying is what for the time value. Okay, so say for example, it would have been only a 1 day contract, then I would not be willing to pay more than 2 rupees or 5 rupees. But if for that, if it would have been in 1 month contract, then I would say that there are chances that it goes beyond 16,400 is what I expect, and that it will earn me profit, so I'll pay a little bit more. And at the money is basically where the current market price and the strike price are almost similar. In our case, it will be at 16,200. Okay, so in a concise form, if we can say, call option will be told in the money if spot price is greater than the strike price. It will be at the money when spot price is equal to the strike price, and it will be out of the money when spot price is less than the strike price. It will be opposite for put options, where put option will be in the money if spot price is less than the strike price. At the money remains the same where spot is equal to the strike price. Out of the money becomes when spot price is greater than the strike price. So anywhere if you have a little bit of confusion, I would advise you take this photo, take this picture of this slide, so that whenever you are revising or seeing the derivatives in the live market, this will be of helpful to you. Now another basic term which we frequently see people talking about is that open interest. Now, what is an open interest? Now, if I just split this word, that one is open and one is interest, that means one open interest into the market or one open position into the market. Now, remember, it's a position. A position will have both a buyer as well as a seller. Say, for example, A buys an option and B sells an option contract. That means there is one open position into the market, or one open interest is there. There are two parties who are interested, and that equivalents to one open interest, because they have got only one open contracts. Okay. Say for example, then on the next day, two new participants come. So C bought 5 options and D sold those 5 options. That means C has 5 open interest, and C and D together combined have 5 open interest. A and B combined have 1 open interest. That means your total cumulative open interest becomes 6. Now there are two scenarios. Say in scenario 1, A exits his position and the counterparty instead of B was D. Okay, so A's one buy open position gets closed and D's one sell position gets closed. So that means now D has 4 sell positions, B has 1 sell position, which makes 5 sell positions, and the counterparty to both B and D is C, where C has 5 buy positions. So the open interest now is that 5 open buy positions from C, and to counter that we have 1 sell position from B and 4 sell positions from D. That means the cumulative open interest is 5. Okay, so that means that that would say that 5 positions are there intact by C, and D's 1 sell position has been consumed by A. Now the scenario second is there, where if we see that C has 5 buy positions, okay, then C sells those 5 buy positions, and that has been bought by another market player, E. So that means A has 1 buy position, C's position has been replaced by E, and the sell position for D still remains intact. D and B remains intact. So that means still the open interest remains at 5. So that means it can be said that instead of C, now C has got out of the market and it has been replaced by E. Now when all this jigging happens during the day, the prices fluctuate because those trades will be happening at different prices. So how do we read that? Was E more aggressive while buying, or was D more aggressive when he was selling, or what? So there are 4 possible positions what can happen. That is that when the open interest was going up, the prices also went up. That means the person who was buying was more aggressive, and we can say that a long build up has happened. That means the person who was doing his long position was aggressive. But when that open interest was increasing, if the prices drop, that means the long was not that aggressive, but the short was more aggressive. Okay, that is the reason the prices have dropped. That means that short has built up his new positions instead of buy positions. So that it means you have long build up and short build up. Now, when those two positions are there and they are liquidating, how would you come to know? Say if the positions are coming down and prices are also coming down, that means the long who had created his positions earlier is selling into the market and the prices are falling off, and that means that longs have liquidated their positions. And someone who is short into the market, who is aggressively buying back his positions, that means the open interest will come down but the prices will be sharply moving up, which where we would say that shorts have now started to cover their positions. So this is important to know the overall trend for that particular index or stock or from whatever instrument you are tracking that open interest for. Generally, a long build-up and a short build-up would show you a trend on up or a downside, while as long unwinding and short covering would show that the primary trend has ended and now you would move to a consolidation to or to a neutral trend, or you need to wait till a new trend emerges. So this is an important concept how to interpret the options open interest changes. Now, how do we trade into derivatives? So now derivative trading is open to all individual investors with a minimum net worth of 2 lakh rupees. You need a trading account or a broking account, a savings or a bank account, and a demat account to keep your collaterals. You need to select the segment in which you want to trade. It can be an equity derivative, a commodity derivative, a currency derivative, or an interest rate derivative. And you need to select an exchange. It can be any exchange which you select or which you prefer to trade for. And say, for example, if you already have a demat and a bank account, then that same can be used to do your derivative trading. Only you need is to open a broking account. Okay, where with any broker, if you can open an account. So it is not necessary where whichever broker you want, you need to have all the three accounts with it. Your existing demat and bank account can be linked to that trading account also. Then you need to wisely select the contracts and the stocks. You have to put in forward the margin requirements, and then you can place an order through an through calling your broker or through an app if they provide it, or their website or many other platforms which they have. And then you can hold the contract or till the expiry or offset it into the market depending how the underlying has moved. So it's very simple. It's not a complicated process to trade into derivatives, but to understand how the underlying will react to the or how your underlying movement will impact your derivative instrument is a little bit difficult, and it needs to be understood thoroughly before entering into the derivative segment. Now, the option pricing time value factor, which I told, that time value factor is decided from a formula which is known as the Black and Scholes pricing model. Now, this Black and Scholes pricing model is a complex formula, but I'll just explain it in very simple terms, where your stock price, the interest rate in that particular asset class. Say for example, if we take an example of equity, we generally take the risk-free interest rate or your bank FD rate as an benchmark. The time to the expiry you extend, the time value will increase. It is directly correlated. The longer the time horizon, the higher the time value would be. And the important factor would be the volatility of the asset class or the underlying asset. Say for example, if you take a highly volatile asset currently, which is crude, that means it will have a higher premium. It is very simple. If a person who is taking a mediclaim, he has many illnesses or critical illnesses, like he has all the illnesses like diabetes, blood pressure, then he has hypertension and n number of illnesses. Or obviously his mediclaim premium will be too high. But compared to that, a person who is, perfectly healthy, has no illnesses, this medical premium would be low. So higher the time, higher the premium. Okay, so it calculates all these things into, it takes into account, and it calculates here overall option premium. If you will go into very deep nitty gritty, it will be very confusing, because if you just Google the Black and Scholes formula and see how that formula is, it has a lot of things. Say for example, it will be strike price raised to the probability of the stock coming to that strike price, minus the strike price raised to the risk-free interest rate into the discounting factor of the probability of actually that event happening. So if I'll explain you like that, it will just go above your head. But if you break it out in simple terms, it has four things into it: the current price, how volatile the current stock is, how long your time to expiry is, and what is the current risk-free rate. And depending on that, it is calculated. Now, trading into futures contract, it's basically has a very linear payoff. It is basically the X amount, it goes down, you will be having a loss. And if it goes up by 10 rupees, you will be having 10 rupees profit multiplied by the contract size or the lot size. And it's a zero-sum game at the end of the maturity. That is that, a person loss and profit will be equal. That is, one's loss would be the other's profit. And at the end of the expiry, its value will become zero, and it will converge to the underlining's value. So that settlement will be done at the underlining's price. Okay, generally futures contract trade into premium, but future contracts are not eligible for dividend. So if there is dividend, there will be discount. On taxation purpose, though I'm not an expert on taxation, but basic simple things are that all the derivative trades earlier were considered as speculative transactions, but now the trades could be offset against other speculative incomes also. And it can be, if it is done through recognized stock exchanges, of course. And also the losses of such transactions can be adjusted against other sources of incomes also. Exception is there that salary income cannot be adjusted against it, and such losses can be carry forwarded for 8 successive years. And also the deduction is there available for the STT which has been paid under such transactions, so that also can be taken under the deductions also. But you need to take into consideration that these all would be only available if it is done under the recognized stock exchanges and not under the unrecognized stock exchanges, and not on non-listed instruments. Before you venture into derivative trading, you need to remember that derivatives are different from equities. It needs a lot more of understanding how that underlining will react to overall movement or changes in the global scenarios, and how that movement will impact your derivative instrument. It is not always linear. A rise in a crude oil price might impact negatively to your put options also. So that all things you need to be taken care of. You need to take professional help also if required, so that it will be more better, it will help you more better understanding in derivatives. Also, it is always if you are new to investments, it will always be prudent to take smaller steps at one particular point of time. A good strategy would be that you start with mutual funds or an SIP, where you understand what markets are, how markets move, and how mutual funds are giving you returns. You get acclimatized to it, and you have adequate balances before you start trading into derivatives, because there might be that there might be a sudden fall, and then a sudden margin requirement will come, and which may which you may not which you I might not be prepared for. So that brings to the end of this presentation, and you always try to be a prudent investor, and you always try to be an investor where you are more informed than relying on someone else's knowledge or information. It is always good to gain knowledge, but it is only for gaining knowledge, but then you invest on your own understanding also, and not on those if someone tells you and you start investing in it. So ma'am, we will conclude here, and we'll open the floor.
Yeah, thank you very much, sir, for insightful presentation on derivatives. You you spoke on it in detail, and I hope all our investors are benefited through that explanation which you have given on each and every topic. Now we put the floor open to people. In case you have questions, you can write it down in the chat box. And currently, we don't have any questions in the chat. So if there is anyone, please do write in the chat box. And Mr. Bora, there is a question for you here. It says that are there derivatives on crypto?
No, there aren't any derivatives on crypto till now, and I guess there is a lot of regulations and discussion still on a crypto itself. So till now there aren't any derivatives on the cryptos.
Yeah, at this point, let me also mention to you in case you have any questions and currently they are not coming to mind. And after the presentation, you feel you need to ask something to us, you can do so at the ID that was provided to you at info@nstl.co.in. But still, we'll wait for some time, maybe a few minutes, to check if there are any questions. And in case there are questions, please unmute yourself and answer, or maybe I'll have to unmute everyone.
Then the question is, does a derivative has to be on an asset class which is kind of recognized by the depository? You know, can it be on the value of land? Something which can be sometimes it can even be notional, right?
Sir, those would be, and we would say, an one-to-one and or an OTC derivative, but most of the derivatives which we have would be on one particular asset class where it is listed in some exchange, and they would have a derivative on it. So say if I can put it like that, that we don't have derivatives on US stocks, right? But they are listed in the US exchanges, and US exchanges have derivatives on them. So because many of the derivatives are physically settled also. So if I buy a right to buy an, for example, Amazon, but when I want to settle it, how would the exchange deliver Amazon stocks to me? So it is more onto your requirement when you are buying a commodity or a crude oil, and if you go for a physical settlement, that crude oil is delivered and storage costs are taken in. So similarly, though in a land, it would be very difficult because one thing is that land is not dividable. Like you don't have multiple parcels of lands, so that is the reason you don't have derivatives on land. But then you have something called as REITs and all, which are there coming in or coming up, which are ETFs on land.
Yeah, that makes sense because execution of the contract will be a problem.
Yes.
Yeah, if it is not if it is not exchange traded. Okay, that makes sense. Thank you, sir.
Thank you, sir, for that answer. There's another question from Mr. Siddeshwar for you. Is it easy to make money in equities or derivatives?
That's $1 million question. It is not that it is easy one side or difficult on the other side. It requires a lot of efforts. Both are difficult and both needs a lot of study to do. So it is not that derivatives is very easy. You need to understand derivatives are leverage instruments. So basically, at a margin of 1 lakh, you may get a contract worth 5 lakh. So that means you are taking an 1:5 leverage. So that may make money fast also, and that can lose money fast also. So in equity also, there is a lot of things to study about before you buy a stock. So both needs a lot of hard work, and it is not easy, be it equity or derivative.
Thank you, sir. Um, I'd wait for another minute, but in the meantime, as in case there is any questions coming up, I would take that. Uh, First and foremost, I would like to thank Mr. Vora for spending his time on this Friday evening with us. I know he has a busy schedule, but he consented to be a part of this webinar today. Thank you, Mr. Vora. And I would also like to thank all the participants today. I know it is a Friday evening. We could have done a lot of other things. Those who don't, who are at home, and it's a Friday weekend, but you have taken a right choice of being here for the webinar because there is always an increase to learn. I had heard somewhere, that the mind never grows old. It only over the years grows for more and more knowledge. So thank you very much for being a part of this program. And without you, I always say this, without investors or without any participants, we cannot conduct a webinar. In fact, I should say in the beginning, there were only two people. So I was thinking whether we should continue or not. So I said, let me check, let us continue for some time and see. There will be, if people have joined, we will continue. So that's how we continued with the webinar. You are important to us, and without you, we can't conduct a session. Sir, there is a question again for you. Are there mutual funds that are built on derivatives?
No, there won't be mutual funds built on derivatives because mutual funds inherent structure is that they need to have the underlining and not the derivative. And derivative will have fixed expiry dates, so there won't be any mutual funds on derivatives.
Thank you, sir. And I think there are no further questions. In case there are, you can always write to us at info@nstl.co.in. And I take your permission to wind this session today. Thank you once again, one and all. And
Thank
I
you, ma'am,
would
for
also say, that please pass on the message to your friends, your colleagues, your relatives, those who would like to gain knowledge on the financial, based on financial education on various topics. And you can also join us for other webinars by registering for various programs that are available, the details of which are available on the website. So thank you very much.
Thank you all participants, and thank you, ma'am, for inviting.
Thank you, sir.
Thank you.